Okay, for this video, I wanted to go over a very simple example as to how to complete a Form 1041 trust tax return for a irrevocable non-grantor trust. Now, trust returns, these can get incredibly complicated, so I'm going to just use a very simple example, a little bit of income and expenses, one beneficiary, and then just show you how the fact pattern kind of works with the return and what some of the basic sections of the return you need to complete, and moving on to the K1s as well. So I've got the sample 1041 in front of us. We'll go through all the relevant fields here. And then I also have a sample fact pattern here that we're going to review, and this is the information we're going to use to populate the 1041 tax return. So what's the fact pattern we've got here? Well, we're going with Jane Smith. She's the U.S. taxpayer, a grantor, and she wants to form an irrevocable non-grantor trust for the benefit of her only daughter. Her daughter is Daughter Smith. Now, Jane has a lawyer draft up a trust agreement, and that agreement is effective Feb 1, 2021, and the agreement appoints John Doe Fake Trust Company, Inc. as the trustee for the trust. Okay, so in this case, the trust is using what's called a corporate trustee, so you're using an entity, an actual business. But a trust can also appoint just an individual, right? So you can have either or, you can have multiple trustees. Some of those options might work for you. But in this example, just one trustee, one fiduciary, and that's John Doe Fake Trust Company, Inc. Now, after that's done, a brokerage account is open for the trust, and Jane, as the grantor, she puts in $14,000 in cash into the brokerage account, and the trustee then invests those cash proceeds into dividend-paying ETF stocks. So during the year, if we look at the brokerage account, that we get that 1099 at the end of the year, it shows that there was $840 of non-qualified dividends paid into the account, and then the trust also had $8 of interest income earned within the account. Now, the trust also had to pay fiduciary fees during the year, right? So John Doe Fake Trust Company charges a fiduciary fee, either monthly, quarterly, or yearly basis to act as the trustee, right? So they charge that $500 to the trust cut them a check for $500. So that was the one expense for the company. Now, under the trust agreement, the trustee has sole discretion to distribute income to the beneficiary. So it can choose to distribute income or not. And the reason why that's important distinction is because that determines whether you have a simple or a complex trust arrangement. In our case, we've got a complex trust arrangement because income does not have to be currently distributed every single year to the beneficiaries. So in 2021, the trustee decided to keep all of the income and not distribute anything to Daughter Smith. All right, so now let's look at the 1041. So in Section A here, we, as I just kind of highlighted, we need to decide what type of trust arrangement is this. In our case, we have a complex trust arrangement, so we've checked the complex trust box. Okay. If you've got a simple trust, obviously you would check simple trust, and then the trust return would be filled out in accordance with those provisions, right? So again, income has to be currently distributed, and so you would have fields completed on page 2 in Section B. But in this case, we've got a complex trust arrangement, so it's a more simple return to complete. So the name of the trust up here, Fake Non-Grantor Trust, under agreement dated Feb 1, 2021. Now, you do have to enter the EIN for the trust. You have to have an EIN. Okay, you can't file a 1041 for a non-grantor trust without an EIN. So go ahead and get that applied for, and you're also, frankly, you're going to need it to even open any account. So in order to open a bank account, in order to open that brokerage account, they're going to want an EIN for the trust. Then name and title of the fiduciary here. So we've got John Doe Fake Trustee Company, Inc. They're the trustee. And then the date the entity was created, they're referring to the trust here. Again, it was formed February 1, 2021. Now for first year trust returns, similar to entities, you note up here it asks, is this trust for the calendar year 2021 or a short period return? So in our case, this is a short period return because it was formed during the middle of the year. So we can enter February 1st, December 31st, and then obviously for the 2022 tax year, it's going to be for the full calendar year, okay? Okay, so in section F here, we have check all applicable boxes. Pretty straightforward, right? This is an initial year return. If any of these other items might apply, then go ahead and check the box and update the information. So if you had a change in fiduciary, if you had a change in address, trust name, you would check those appropriate boxes and then make sure all of the current information is updated here. Okay, so now let's look at the income and deductions. So the income section, you report just that, right? The income, interest, dividends, is there any qualified dividend amount, capital gains, so on and so forth. So again, you remember our fact pattern. We had $840 of ordinary dividends, so non-qualified dividends, and we had $8 of interest income. So we put those two income amounts up there. That's only income we've got in the trust for the year. And then down here in the deductions, you are allowed to deduct expenses in connection with operating this trust, right? So if you have fiduciary fees, that's the $500 we pay to the trustee. If you have to pay for attorneys, accountants, tax return prep fees, you can deduct those amounts here. Now, obviously, all of these are subject to certain limitations, and you've got to allocate between, in some cases, allocate the the expenses between corpus, which is principal, or just income. But again, we're very, very straightforward example here. So, we're just deducting the expenses there. We don't have any allocations going on here. So very simply, total income minus the expenses. And then every trust gets a $100 exemption. So that's basically another deduction, kind of a below the line deduction. And so our total taxable income for the trust is $248. And then the tax is roughly 10% on that amount. So if you look at the trust tax rate tables, if you go to the form instructions, they have a tax rate table in there depending on how much taxable income you have. I think the threshold is about $2,600 some odd dollars. So if your trust taxable income is anywhere between $0 and $2,600 for 2021, the tax rate is 10%. And obviously if you have more income than that, then the rates change a bit. Okay, so that's the computation there. Some other things I want to touch on that don't apply here because, again, we're doing a very simple example. But Section B is where you would have an income distribution deduction if this was a complex trust that distributed income to the beneficiary. So what happens there? Well, not only are you completing this section because you have income that was distributed to the beneficiaries, but it also splits kind of the tax liability between the trust and the beneficiary. So I think the better way to illustrate this is if we look at the K1, perhaps that'll be easier to understand. So if we look at the K1 here for the beneficiary, right? This is for daughter Smith. She's the beneficiary of the trust. Up here we've got the trust tax ID number, name, the fiduciary's name, and other information. And you'll note here that all of these fields in Part 3 is blank. Right? So the trust earned income, right? It had income and expenses, it had interest, it had dividends, but because none of the income was distributed to the beneficiary during the year, this K1 is effectively blank because none of the income is being passed on to her as the beneficiary. If you did distribute cash to the beneficiary during the year, you would have to compute the income distribution deduction. And effectively what would happen is once you do that, you are going to see some of these fields start to populate in Part 3. So some of the interest income is going to be passed on to the beneficiary, and she will report that income on her return and pay tax there. So interest, dividends, if the entity has capital gains or losses, those amounts might be passed on to the beneficiary if there is cash distributed out during the year. Again, in our case here, we've got a simple complex trust where all of the income was retained within the entity. The entity's paying the tax, so there's no property distributed to the beneficiary during the year. I'll have a separate video on perhaps a more complex one where there are income distributions, but in most cases with these irrevocable trust arrangements, cash isn't being distributed to the beneficiaries because it's being stockpiled for a later date, right? So you might have a trust arrangement that says, okay, the trust is going to just pile up all this income. It's going to pay tax where it needs to. And then when my son hits age 30 or they need money for school, then we'll start distributing some cash out. But for the most part, every single year, there's no income distribution deduction because all of the income is being retained within the trust. Okay, so that covers it. I hope that was helpful. If you have any questions, please leave me a comment below. Happy to answer when I can. And I look forward to seeing you again on the next video. Thank you.